Inflation, it never seems to go away. Check out this Mustang, $3,900 new. Coming up on today's program, best ways to make money during inflation. Welcome to What's Next with Money, a program with smart insights to guide your financial decisions. Let's get started. Think of inflation as an indexing method. Whatever it attaches to, that item changes. Inflation pushes up prices like food, gas, rents, or subscription. It's basically too much money and demand chasing too few goods. And there are a lot of contributors: war, embargoes, supply chain issues, pandemics, lockdowns, layoffs, tariffs, economic snapback from big events, like all created economic disruption. But inflation can affect relative value. And you might have heard of something called shrinkflation. In order to maintain and grow price, competitiveness and market share, and attractiveness with consumers, companies engage in shrinkflation. It impacts the value of the size of the item or the amount of the service. And you might have seen it with like a cereal box. There's probably less cereal inside. I have a more vivid example for me. I like comedy, and there's a great national comedy club near where I live. And so recently I went there after the pandemic, and there's like a 2-item minimum. So I ordered my normal little food item, and it usually looked like this when it came. Instead, shrinkflation made it this. Same price, if not higher, but this is what I got, and I just sat there in shock, and it was not funny. Service shrinkflation, you may have experienced this at motels or hotels, where daily room cleaning may be an option or may be a higher price service. You can get new towels, but your room's not going to be clean until you check out. And we're going to see and have seen interest rate rises through the Fed affect credit card rates, certainly mortgages, trickling down to rents, landlords charging more. Now, student loans, for some, yes, but a lot of student loans are fixed, so there's a little inflation advantage built in there. Adjustable rate mortgages, big time. And in your contract, if you have an ARM, an adjustable rate mortgage, it will specify how much that mortgage payment can move up and down per year, and there may be an overall cap on that rate. Home equity line of credit's definitely affected. As you go for an auto loan, also inflation interest rate sensitive. And by the way, I would recommend, because of the higher price of gas, if you have a functioning car and it's paid off and you know how to maintain it, dumping that car and then buying a new or a newer used one just to save a little on the gas mileage, that may not be worth it. I'm driving right now a 20-year-old SUV that I love, that I bought used. The mileage is not great, but my costs are so low. I'm not happy with gas prices being higher, but I can tolerate it. And then, of course, there are commercial loans that can be affected by interest rates. Even insurance premiums can pop up over time. So inflation can be indexed, though instead of just prices rising, can streams of income be affected by inflation, perhaps in a positive way. For people that have pensions, it's unlikely that pension is inflation adjusted. However, salary and rents, those can be. Most are not inflation adjusted, but we're going to cover a few that are. Social Security benefits. Annually, they are reset based on the cost of living. So it's an inflation adjusted annuity. It is a stream of income flowing in annually when you've elected to claim that, and we recommend claiming them as late as possible to make that check as high as possible, but it's inflation adjusted. Now, tax benefits and deductions might be indexed for inflation, but many are not. And if they're not, like the exemption on a home sale, that exemption level has not been inflation adjusted, and it probably hasn't been adjusted for 20 years. And when those things are locked in, not sensitive to inflation, the government gets more money. There's less of that deduction benefit floating up or credit floating up to you. Now, there are also inflation riders that you may elect to add to certain insurance policies, like long-term care. And these are for payment of nursing homes or in-home care many, many years in the future. And having a cost of living or an inflation rider on those policies is very important. Yes, that you pay an increased premium for that, but if you lock that in early, a lot of those premiums stay constant, but you've built in some inflation protection. And then for homeowners insurance, a critical area is replacement cost coverage. By getting this higher form of coverage, it accounts for changes with building codes, the cost of materials, and the cost of labor to rebuild a home or repair a home should there be some challenge, some accident or challenge. Now, other things can be informally indexed, and here's where we pop into salaries. You may receive, or family or friends, an annual or periodic inflation-adjusted cost of living raise. This is not a merit raise. It's not based on performance. But the company or the government agency or nonprofit wants to keep employees. It's harder to rehire and retrain. And so they want your salary to at least grow with inflation to somewhat keep current. And it's important not only to look for those cost of living increases, but make sure you're tapping into all the benefits you have, because that is a form of compensation as well. You could ask for a raise, look to get paid what you're worth, but in these challenging times, if you change jobs, you got to watch what's going on with benefits. And if there's a recession on the horizon, last hired, first fired, you've heard of that, so be careful there. We have a great video on boosting your human capital performance in a video called Boost Your Small Business Success. It has a lot of great ideas for income alternatives. And then if you happen to be a landlord, if you have a rental home, perhaps your first home that you rent out, you can adjust those rents based on cost of living, and that gives you some inflation protection. Of course, if you are a rentor, you're subject to those inflationary cost pressures. Now, before we get into playing offense and defense with inflation, best ways to make money during inflation, what's your advice or experience? Let me know what you think in the comment section below. Now, how can you make money during inflation? Let's move right into playing offense. Stocks and mutual funds might do well in inflationary environments, but not all of them. It's the companies that can raise prices with healthy balance sheets, not too much debt, stable management, something called moats in their market share. This is their distinct advantages from their competition in the marketplace, their brand, their intellectual property, certain proprietary technologies and systems, and of course, pricing power. These moat-type attributes become barriers against the competition and keeps that company in sort of a higher place of market competitiveness. And of course, the company, you should ask, can they pass on rising costs to customers while letting their profits and perhaps even the dividends they pay out grow? And that leads us to dividend-paying stocks. This can help with the idea of total return of an asset. Usually dividends are paid on a quarterly basis, and dividends can be a great tool if you receive them in a taxable account to help fill up emergency and short-term, medium-term savings accounts. It's an extra source of income. Now, some banks and credit unions, they certainly offer CDs or certificate deposit. Over time, those interest rates they pay will creep up, but it's going to be in a different gear and much slower than the overall inflation rise that we're seeing. Investment I like is called I bonds. These are the best non-stock, non-equity investments around. These are U.S. Treasury Series I savings bonds. They are savings bonds. There is no risk to principal. And check this out, the interest rate adjusts every 6 months based on the consumer price index. Just recently, the interest rate was over 9%, 9.6%. And 6 months ago, the I-bonds paid nearly 7%. Now, you could hold an I-bond for up to 30 years, so you can kind of set your own term. You buy them and you can hold them. And there's no tax on the interest until you redeem them. And the only tax you're really going to pay is federal tax, not state or local income tax. Bottom line, you hold it for at least a year. If you cash out before 5 years, there's a 3-month interest penalty on the cash out, which is very modest. There are no commissions, there are no fees. You can buy an I-bond for as low as $25. That's the minimum, but there is a maximum. An individual can only buy $10,000 of I-bonds total per individual per year. There's a little bonus opportunity here. A household annually could take $5,000 of a tax refund, a federal tax refund, and buy I-bonds directly to Treasury Direct, the website. And I'm going to have a link to the website in the comments section. So an individual could actually buy maximum per year $10,000 for themselves and then $5,000 from the tax return. And you might say, I don't have tax refunds that high or nearly that high, and you don't have to go up to the $5,000 limit. But here's what you can do. You could create your own tax refund scenario. If you're working and you have money taxes withheld from your paycheck, you can adjust your withholding, talk to your HR professional to have more taxes withheld, and you may end up in the spring with a higher or more substantial refund. If you're retired or a small business person and you pay estimated quarterly tax payments, you can increase the size of those quarterly tax payments also to induce your own tax refund. Now, where do you buy I-bonds? It's called the Treasury Direct Program. And I'm going to have a link for it. You basically go to the site. Now, folks, the site's a little clunky. It's like it was made in 1999. It doesn't have the best user interface design, but the Treasury Department is in the works to update it. But I actually, about 8 months ago, set up an account, went online. In my prior tax year, I bought an I-bond for myself and for my wife. And then when the year changed, so I did that in December, and then in January, I bought another 2 sets of $10,000 I-bonds. And it was very easy. You set up an account with Treasury Direct. You get your own password. Again, there are no commissions. You don't go through a bank. But then you have to link that account to a bank where the money will come from to buy your I-bond. It's the best thing going out there. Now, there's another form of inflation-protected security called TIPS. This is called Treasury Inflation Protected Securities. Folks, I-bonds are better. With TIPS, taxes are due every year. The prices can fluctuate more, and they are more complex to manage. So if you're getting value from this video, please hit that subscribe and especially that like button. This helps move our content to more people and others who want to learn. Let's look at some more ways of playing offense here about inflation. A general look at asset allocation is really informative. Asset allocation is a mix of your stocks, bonds, cash, real estate, and commodities. Those are some of the main big asset classes. And don't forget, your small business might fit into this, as well as your human capital, your personal income earning power. And I've got a video that discusses asset classes that's very helpful called Can Cash Be an Asset? And we'll have a link to that. But for inflation sensitivity, real estate and commodities as big parts of asset classes can be helpful. For the real estate area in ETFs, mutual funds, they're known as REITs, R-E-I-T-S, Real Estate Investment Trusts. And buying into those kind of groups of REITs, not just buying one, is good diversification, and it can help your portfolio. And you might want to, again, dollar cost average into those over time. Commodities are harder to invest in through ETFs and mutual funds. There are some funds, and there's a lot of volatility, and you're going to really have to look at the performance down the road. Now, for my hopefully thoughtful asset allocation of the past, I did have a commodity type fund, and it was interesting. It was not correlated to the stock market, so it gave me diversification. But we went through this very long period of low interest rates, and guess what happened? They shut it down. I had my money returned to me. I didn't even have a choice. So I got de-diversified from a mutual fund company. And I didn't really like that, because later that would have been a good thing to have. But there are many other classifications of types of asset allocation: the size, growth, value, the style, the size, small, mid, cap, large, domestic and international. And again, I cover those in that other video. But don't forget your retirement issues as it relates to making money. Remember, Social Security payments are inflation adjusted. By claiming later, that paycheck from Social Security is bigger. And you can bridge the time to claim that later by working longer, and that way you can save more. But just remember, Social Security is inflation adjusted. So we've been talking about ways to play offense, about making money during inflation. Another way to literally bring income or stop outflow from your household is to play defense. So let's look at playing defense while we make money during inflation. And of course, keeping an eye on your credit and cash flow is critical. In the credit area, paying down debt, that actually gives you a real rate of return. If you've got 21% on a credit card and you start paying that off, you're getting somewhat of a 21% return. And you can't get that in so many other investments. It's an important thing to do. Now, some people that have really good credit records, top credit score, unfortunately, if they have a credit card balance, they could consider, this is not for everyone, a balance transfer to perhaps grab a zero interest rate for 6 months with another credit card firm. But this would be the period you would have to have the discipline to pay it down. You will need to read the fine print, because you might be tapping into a higher interest rate. Remember, interest rates are kind of on the upswing, so that will catch up with you. But it could be a interesting way to pay off debt before the new interest or higher rates pop in. There is likely to be, though, a fee on the transferred balance as you transfer it and pay it down, but it requires excellent credit. I'll have some tips on this and other items related to credit and credit cards from the CFPB, links in the comments section. Now, consumer debt also includes student loans. You can perhaps get your workplace to help you pay some of those down. Student loan repayments are being encouraged by Congress as an employee benefit, and many workplaces are doing that to retain workers. Mortgages are a big issue, especially if it's an adjustable rate mortgage, and there's usually a cap rate of how high that can go, and maybe there's a rate that it can fluctuate per year. There might be a cap on that. Adjustable rate mortgages perhaps can be a tool of affordability, but you've got to check the worst case scenario. What are the ranges these can move? And it may be helpful if you can't sell a property or refinance, if you have to tap into that. But fixed is preferable. Obviously, you want to go after a fixed rate, low interest rate. Keep that if you need to. If you want to pay down based on that, you can. But if that rate is below the rate of inflation, be grateful. Home equity lines of credit also are adjustable. And if you have your house paid off, it's always good to have one of those, because you can use that to buy rental property, help you out in some emergency or some other kind of investment opportunity you might feel is good. Auto loans. And let me move right over to auto leasing. I'm going to give you a tip here that's pretty interesting. If you're in an auto lease, Usually your payments are fixed, and at the end of the lease term, there is a predetermined, pre-negotiated set price in the contract called a lease-in price of the manufacturer's, their perception of the remaining value of that car. At the end of your auto lease, you could go buy the car you have, the one you're leasing right now, for that negotiated price. It's very likely that that lease-in price does not reflect the inflation we're having now. It could be a bargain, and it could be much lower than a replacement new car, a new lease, or even a used car equivalent. And guess what? If you do this, you are buying control. You've bought agency. You now own and do not rent or lease a car, and you've got it now at this special price. And you could even have the option of selling it because you got it at that lower price if you wanted to, if you didn't need it, and make some money. So this tip comes from my friend Jonathan Guyton, certified financial planner professional of Cornerstone Wealth Advisors, a fee-only firm in Minneapolis. Now, another point of playing defense on inflation is the using up of mileage, merchandise, and hotel points. These are all the bonus points from credit cards or spending at different hotel chains or airlines. These are subject to shrinkflation, like that comedy club meal I gave you as an example earlier. These, though, can be a source of gifts as well as for holidays, weddings, and graduations. Your buying power is likely to erode as the sponsoring companies reset the worth of those points. So this may be a good time to use them up and lock that in, and therefore then you're using points to spend rather than cash, and hopefully not credit. Another area that's growing in popularity, but there are some regulatory concerns, and that's buy now, pay later. I've got a link to a video on that in the comment section. So cash flow. This is part of playing defense and how you can make money during inflation. So your cash flow should help top off and grow your emergency savings. It feeds into your budget, knowing kind of where you are, your income and expenses. And it's also important, if you're retired, you need to budget for taxes. It's one of the biggest expenses that you'll pay. And to initiate a big expense cut, bring you a little bit of a raise, check out your subscription services. The pricing, those prices go up, and now you might want to annualize how much you're spending on subscriptions. And this is beyond streaming. There are subscriptions for everything. Check this out. I just found out just a week before I created this program, BMW just announced a subscription service for their cars. You thought, what, is this like renting a car? No. Check this out. You can buy a car from BMW or perhaps lease it. And if you want a particular option like a heated steering wheel, heated seats, you pay BMW a subscription price for that. Check this out. You are renting and subscribing to your hands being warm and your seat being warmed. Now, how can they do this? I think you're going to see more of this kind of revenue generation options for different companies that are technology based. They have the master control system back just like a cable company does. They can turn on and off that pay-per-view, on and off those premium channels. Car companies will be able to turn on and off different features already built into the car, but not functional unless you pay them more money. So this is part of their, quote, after-sales strategy of upselling. This I found wild. Anyway, home expense repairs that cause outflow of money. You could repair your home in certain ways to save on energy, property tax, and older folks can actually apply to their county and state in some cases and get a special property tax exemption to lower that property tax bill. Also, you can always drop heavy activities, things that you don't do or use as much, saving on taxes, rent, subscriptions, storage fees, maintenance, etc., and fuel. Perhaps do a lifestyle audit over a month. Look at what you're spending. This is how you develop a budget through a spending plan. And extrapolate some of those items that you subscribe to or maybe have in your possession that you use infrequently and how frequently, and come out with an annualized number on that. You can determine this from your bank and credit card statements, your online statements, and many of these credit card companies now have a breakout showing recurring expenses, which I think is really helpful. They have an internal way using artificial intelligence to code those, and that can give you a quick snapshot on what these recurring expenses are. And we've already lived through, as a country and as collective families, in being able to adjust our spending and increase our savings. And we did that during COVID. Also, plan your tax refund. Great option annually to save, pay down debt, celebrate, or buy one of those great I-bonds from Treasury Direct. And think about buying stuff on sale, monitoring your cash flow, changing the time of year you might buy something, especially non-perishables, and back-to-school items, maybe when they're really on sale, sort of out of sequence. Sometimes different states drop or lower sales tax during the month of August on back-to-school items to help families out. You can always sell stuff and try that Marie Kondo happiness test. Does this item, does the time and service, does this experience continue to give me joy and happiness? And in the next few years, can and will I keep doing it? This moves to the issues of collections, RVs, an extra car, timeshares, boats. Again, the taxes, maintenance fees, storage, insurance. And there may be even extra liability with some of these ideas. Can you transfer those costs to somebody else, have them shoulder, and perhaps give you occasional access? So we've been talking about playing offense and defense, how you can make money during inflation. But check out our other inflation fighting video showing what you can do to be in control. 6 tips and tactics to beat inflation. So be sure to hit that subscribe and like button, and don't forget to share. Remember, new episodes of What's Next with Money are posted on Thursdays.